All right, welcome to Blockchain Tech and Finance News with me, your host, Kentoshi. If you're on the YouTube side, please do subscribe, turn on the bell notifications. I'm going to go right on into markets. I'm going to check the monitors along the way as well, so if I need to stop or adjust the audio. I can see you in the chat, so if you want to throw your chats in there, I will have all these news article links in the recap on the YouTube side. We're going to start out by going into the markets on the U.S. markets. Watch. Let's see. News article links in the. All right, monitor's working. Pause the monitor. Let's go right on to it. So we got the U.S. Dow down 0.27%, the S&P 500 down 0.61%, the Nasdaq down 0.9%, VIX up 1.79%, gold is down 0.38%, oil is down 2.51% in the Europe markets. We have the FTSE 100 up 0.66%, the DAX up 0.08%, the CAC 40 up 0.1%, FTSE MIB up 0.55%, the IBEX 35 up 0.51%, the Stock 600 up 0.35% in the Asia markets. We have the Asia Dow up 1.33%, the Nikkei 225 up 1.78%, Hang Seng down 1.18%, Shanghai down 0.77%, Sensex up 1.31%, Singapore up 1.11%. In the Forex markets, with the euro down 0.76%, the yen up 0.76%, the pound down 1.3%, the Australia dollar down 0.3%, DXY index up 0.69%, the WSJIDX is up 0.65% in the rates market. With the US 10-year up 0.0356, Germany 10-year up 0.043, Italy 10-year up 0.1703, Spain 10-year up 0.1004, UK 10-year up 0.0384 points, Japan 10-year up 0.0027 point. Futures, we've got the GGIF futures down 1.16%, S&P futures down 0.47%, Nasdaq futures down 0.93%, gold down 0.36%, silver down 0.01%, and crude oil futures down 2.40%. In the crypto markets, we have Bitcoin in USD $20,362 per BTC. That's down 1.57%. Ethereum is down 2.06%. XRP is down 2.3%. Bitcoin Cash is down 2.02%. Litecoin is down 2.35%. And Monero USD is down 0.97%. Let's go on to our first piece of news here for the day. I have some interesting news, definitely noteworthy to read from. Save some energy computing power here. A little data packet loss. All right. Argo blockchain is at risk of closing if it fails further financing. So we're going to go into the two pieces of blockchain, or a few pieces of blockchain news, maybe two or three, I'm not really sure. Whatever's on the list there. Then we're going to go into some NFT, crypto news, and then some NFT news, some metaverse news, some finance news, tech news, and global news, and close out the stream for the day. Argo blockchain is at risk of closing if it fails further financing. This is from writer Helen Parts, writer for Cointelegraph. Argo blockchain has been selling its Bitcoin holdings earlier this year to cut debt to Michael Novogratz crypto investment firm Galaxy Digital. The London Stock Exchange listed cryptocurrency firm Argo Blockchain has warned that it's at risk of ceasing operations due to a lack of financing. The crypto mining company Argo Blockchain continues to explore new financing opportunities after failing to raise major capital from a strategic investor, according to an announcement on October 31st. Argo has been seeking to raise about $24 million British pounds, about $27 million in USD, via subscription for ordinary shares. This company no longer believes that this subscription will be consummated under the previously announced terms, Argo said in a statement. While Argo is exploring other financing options, there can be no assurance that it will sign any definitive agreements of consummate deals. The firm will continue to work to reach sufficient capital for at least the next 12 months from the day of the announcement, Argo noted. Argo will have to cut or even halt operations in case it fails to raise capital during the period, the firm noted, stating, should Argo be unsuccessful in completing any further financing, Argo would become cash flow negative in the near term and would need to curtail or cease operations. Amid the lack of financing, Argo has been taking measures to preserve cash and optimize liquidity. The company sold 3,843 brand new Bitmain S19J Pro miners for $5.6 million, which was the last batch of the original Bitmain order scheduled for installation on October 22nd. Argo's total hash rate capacity remained at 2.5 exahashes per second. Previously, Argo had been actively selling its mined Bitcoin holdings in order to cut debt to Michael Novogratz crypto investment firm Galaxy Digital. In July, Argo sold another 887 Bitcoin after previously getting rid of 637 Bitcoin in June 2022. In doing so, Argo became one of the many crypto mining firms that opted to sell self-mined BTC amid the bear market of 2022, including Bitfarms, Core Scientific, and Riot Blockchain. Argo is not the only crypto mining firm that has been struggling to keep operating amid the ongoing bear market. On October 26th, Bitcoin miner Core Scientific filed forms with the United States Securities and Exchange Commission warning about potential bankruptcy proceedings. The firm cited unfortunate industry events like the low BTC prices, increased electricity costs, and other issues. So that's that there. Argo Blockchain is at risk of closing if it fails further financing. It doesn't even look like it's a blockchain. It's just a mining firm. Unless it has a blockchain that's operating as well. I'm not sure. All right, let's go into the next piece of news here. This is from CoinDesk in the market sector from writer Jocelyn Yang. Surging popularity of Ethereum staking keeps lids on yields. Over 14 million Ether worth more than $2 billion are currently deposited on Ethereum blockchain, data shows. But as the stake pool gets larger, it also lowers the yields. Ethereum staking appears to be the new favorite way for crypto traders to capture yield, so popular, in fact, that it's driving the yields lower. That's a consequence of the formula used to calculate the yields under the Ethereum blockchain's month-old proof-of-stake model. The staking yields are awarded in Ether to the native cryptocurrency of the Ethereum blockchain. The total amount of Ether available for staking yields is divided between all the accounts that are staking. So the more Ether that's sent to the blockchain for staking, the lower the percentage that's available for each staker. According to Coinbase Institutional, the staking yield post-merge looks to be about 4% to 5%, well below the 9 to 12% that the analysts initially forecasted. One problem for now, according to crypto analysts, is that investors can't take immediately out their Ether out, so they're stuck in the protocol even if the staking yields keep declining. The withdrawal option won't really become available until Ethereum's next significant upgrade, Shanghai, expected to occur in 2023. You can only put stake in but can't stake out, said Nick Hotz, vice president of research at the digital asset management firm Arca Funds. So unlike in traditional bond markets where yields can rise or fall based on supply and demand, Ethereum staking yield isn't responsive. In the future, that will be responsive, and it looks a lot more like a bond market where there are more interest generated if there's going to be more going on in the economy, Hotz said. According to the data from Dune Analytics, more than 14 million Ether worth over $2 billion are being staked on Ethereum blockchain, including a spike in deposits during the third quarter. When the shift of the proof-of-stake model took effect, known as the merge, that amount of Ether staked is up 7.5% from the end of the second quarter. The merge was intended to make the Ethereum blockchain more energy efficient than its former proof-of-work model, also the same system that the Bitcoin blockchain uses. Under the proof-of-stake system, the blockchain security, making more transactions go through as intended, in that the cryptocurrency is safe, is provided by validators who stake their Ether as a sort of guarantee. Becoming a validator or staker requires at least 32 Ethereum, about $50,600 worth of ETH, to be locked up on the blockchain. But as more stakers rush in and more ETH is deposited, the yield gets spread out more thinly. Hotz said that Ethereum's staking yield is typically determined by four variables: gross ETH issuance, transaction fees generated per day by Ethereum, burning rate, and the amount of ETH being staked, the denominator growing. There's a formula, in fact, that annualized staking yield is annual gross ETH issuance plus annual fees, 1% of fees burned, average ETH staked over the year. In other words, the amount of Ether staked is then the denominator of the fraction. So as the number gets bigger, the yield shrinks. At the current level, the Ethereum staking yield is roughly on par of that that of the 10-year U.S. Treasury note yield, which topped 4.2% this year, the highest level since 2008. The takeaway is that stakers are apparently content to collect roughly the same yield by sticking their money into the Ethereum blockchain as by investing in AAA-rated U.S. government bonds, concerning among the world's safest investments. The staking growth is a sign that traders find it a reliable alternative to the traditional markets, Alan Goldberg, market analyst at Best Brokers, said in a note. Making deposits for a year without access to your funds is a risky move, especially if the funds are in crypto, said Goldberg. However, traders continue to stake. It just proves that many traders feel secure with Ethereum. So that's this here. Surging popularity of Ethereum staking keeps the lids on the yields. Let's go into the next piece of news here from CNBC. Bitcoin's trading has become boring, but that's not necessarily a bad thing. This is from writer Ryan Brown and Arjun Karpal. The key points for this is for the past few months, Bitcoin's price has bounced stubbornly around 20,000 in a sign that volatility in the market has settled. Bitcoin's 20-day rolling volatility fell below that of the Nasdaq and S&P 500 indexes for the first time since 2020, according to the data from crypto research firm Kaiko. Bitcoin being stuck in such a range does make it boring, but this is also when retail loses interest and smart money starts to accumulate, Vijay Iyer of crypto exchange Luno told CNBC. Bitcoin's lack of volatility lately isn't a bad thing and could actually point to a sign of bottoming out in prices, analysts and investors told CNBC. Digital currencies have fallen sharply since a scorching run in 2021, which saw Bitcoin climb as high as $68,990 per BTC, but for the past few months, Bitcoin's price has bounced stubbornly around $20,000 in a sign that volatility in the market has settled. Last week, the cryptocurrency's 20-day rolling volatility fell below that of the Nasdaq and the S&P 500 indexes for the first time since 2020, according to the data from crypto research firm Kaiko. Stocks and cryptocurrencies are both down sharply this year as interest rate hikes by the U.S. Federal Reserve and a strengthening dollar weighed on the sector. Bitcoin's correlation with stocks has increased over time as more institutional investors have invested in crypto. But Bitcoin's price has stabilized recently, and for some investors, that easing of volatility is a good sign. Bitcoin has essentially been range bound between 18 to 25,000 per BTC for 4 months now, which indicates consolidation and a potential bottoming out pattern, given we are seeing the dollar index index top out as well. Vijay Iyer, head of international crypto exchange Luno, told CNBC in emailed comments. In previous cases, such as in 2015, we've seen BTC bottom when DXY has topped, so we could be seeing a very similar pattern play out here. Anthony Trenchev, a co-founder of crypto lender Nexo, said Bitcoin's price stability was a strong sign that the digital assets market has matured and is becoming less fragmented. So is this an end of crypto winter? Cryptocurrencies have suffered a brutal comedown this year, losing $2 trillion in value since the height of the 2021 rally. Bitcoin, the world's largest digital coin, is off around 70% from its November peak. The current so-called crypto winter is largely the result of aggressive tightening from the Fed, which has been hiking interest rates in an effort to tame rocketing inflation. Large crypto investors with highly leveraged bets like Three Arrows Capital were floored by the pressure on prices, further accelerating the market's drop. However, some investors think the icy may now be beginning to thaw. The ice may now be beginning to thaw. There are signs of an accumulation phase, according to Iyer, when institutional investors are more willing to place bets on Bitcoin given the lull in the prices. Bitcoin's being stuck in such a range does make it boring, but this is also when retail loses interest and smart money starts to accumulate, Iyer said. Matteo Dante Peruccio, president of international digital asset management Wave Financial, said he's seen a counterintuitive decrease in demand of traditional institutional investors in crypto during what is a time where generally you would see interest fall off in the traditional markets. Financial institutions have continued taking steps into crypto despite the fall in prices and waning interest from retail investors. MasterCard announced a service that allows banks to offer crypto trading, having previously launched a new blockchain security tool for card issuers. Visa, meanwhile, teamed up with crypto exchange FTX to offer debit cards linked to users' trading accounts. Goldman Sachs suggested we may be close to the end of a particularly bearish period in the late cycle of crypto movements. In a note released Thursday, analysts at the bank said there were parallels within Bitcoin's trading in November 2018 when prices steadied for a while before rising steadily. Low volatility in November 2018 was followed by a large Bitcoin bear market, Goldman analysts wrote, adding that crypto QT quantitative tightening occurred as investors poured out of stable coins like Tether, reducing liquidity and circulating supply of USD coin. A stable coin that's pegged to the US dollar has fallen $12 billion since June, while Tether's circulating supply has dropped over $14 billion since May. Selling pressure has slowed too as Bitcoin miners reduce their sales of the cryptocurrency, suggesting the worst may be over for the mining space. Publicly traded Bitcoin miners sold 12,000 Bitcoins in June and only around 3,000 in September, according to Goldman Sachs, while Wave Financial's Peruccio expects the second quarter of next year to be the time when crypto winter finally comes to an end. We'll have to see a lot more failures in the DeFi, decentralized finance space, and a lot of smaller players, which is absolutely necessary for the industry to evolve, he said. All eyes on the Fed. James Butterfield, head of research at crypto asset management firm CoinShares, said it was difficult to draw too many conclusions at this stage. However, he added, where we err on the side of greater potential for upside rather than further price falls. The largest fund overflows recently have been in short Bitcoin positions, US $15 million this month, 5% of the AUM, while we have seen small but uninterrupted inflows into long Bitcoin over the last 6 weeks, Butterfield told CNBC via email. The main thing would lead to greater buying of Bitcoin would be a signal from the Federal Reserve that it plans to ease its aggressive tightening, Butterfield said. The Fed is expected to hike rates by 75 basis points at its meeting next week, but officials at the central bank are reportedly considered slowing the pace of future increases. Clients are telling us that the Fed pivots or is close to it, they will begin adding positions to Bitcoin, Butterfield said. The recent liquidations of net shorts is in sync with what we are seeing from a fund flows perspective, implies short sellers are beginning to capitulate. Bitcoin's trading has become boring, but that's not necessarily a bad thing. So that's that there in the CNBC tech sector of cryptocurrency. Let's go into the next news article here. Alright, to go into some NFT news here. This is an introduction into decentralized NFT catalogs. This is from writer Ivan Sokolov. Last year's hype over non-fungible tokens, people have been speculating about their potential. It created a bubble of unfounded expectations. Over the last year, venture capitalists poured more than $4.6 billion into infrastructure and projects related to non-fungible tokens or NFTs. This infrastructure now needs users. So this industry, where was I? Yeah. Just going to read my glasses here. This infrastructure now needs users. They will come when people understand that they can apply these NFTs not just for speculative purposes, but also to design and structure their everyday activities. For these, they don't need NFTs. They need to sort their lives out, and decentralized catalogs are there to help them do it. We can think about an NFT as a book someone owns, and this ownership is recorded on the blockchain, but what we're actually missing is the library. So not just a flower, but a garden. Multiple NFTs making up a collection form a system. The system has a structure throughout the standards it uses. If you ever visited CryptoKitties, you probably noticed the museum-like categorization of the kitties and their attributes in their catalog. However, each item in the collection means nothing without the collection itself. You can't take a CryptoKitty out of the original smart contract. You can copy the image or create a fractional version of it, but you will not be able to transfer its value of the derivative version of your CryptoKitty if the derivative version of your CryptoKitty isn't linked to the original collection. This means that the value of each NFT is not determined by a standalone item in the collection, but by the collection itself. In simple words, if we take a step back from each item in almost any NFT collection, we'll discover that the actual value is not a single NFT itself, but in a perfect system of multitude NFTs bound together by one smart contract. By doing this, we stop staring at a single flower and realize we are in a well-designed garden. So basically what that means is that you have a collection of, say, 1,000 pieces of artwork, and then there's the base body, which is, you can see here, you can see these little cats here, and the base body is the cats. Then they have eyes, and then, and all these different aspects, but look at what's the differential with them. They have different colors, okay? And then other collections now have evolved to say, okay, maybe there's a different collection of cats. Maybe there's crypto dogs, okay? And then there's dogs, but then the dog's eyes have different eyes and different eye colors, different tails, but also different dog colors, but maybe they even have different ears. And then maybe they have jewelry, like a bracelet or a watch on their paws here or something like that. And then they have a hat or a halo over their head. Those attribute to all different what's called traits in the entire collection of an NFT collection. So depending on, say, the halo over, say there's a halo over them or a hat and then a watch. Say the cat has a halo, a watch, and a pair of sunglasses on and polka dotted rare skin, where other ones don't really have that so much. So that one NFT becomes more valuable because it's read from the entire smart contract of how many of those type traits are in that collection. And if there's not many, or if it's 1%, or maybe it's only a 1 of 1 in that collection, that makes it very immutably rare, and it's all structured to the core contract, the smart contract. That's tying in the whole collection of each individual NFT within the entire, again, like this is saying, well-designed garden. Well-designed collection. When applying to all standardized approaches and structuring all the data properly, we are creating systemic lists of items publicly stored on the blockchain, decentralized catalogs. How decentralized catalog can add new value. Everyone has heard of Guinness World Records, Michelin Guide, or IUCN Red List. In a nutshell, they are all extremely valuable catalogs. Behind each of them is a managing authority that invests its brand and expertise into bringing value to every new iteration of the catalog. Even if the rules of adding new items to centralized lists are not transparent or even questioned, this approach is sustainable. However, the biggest problem these catalogs present is an extremely high barrier to entry for new valuable lists to enter the market. Though through NFT infrastructure and a Web3 mindset, though, we can democratize the process of building valuable catalogs. The difference between a normal list and a decentralized catalog is the potential value of it can accumulate. So, for example, how present is the team? Is this just a piece of artwork that was just thrown out there randomly and then disappeared? They had no co-founders on it, had no team behind it, no one was even known. Maybe the project was only a piece of artwork and a picture and nothing more. Maybe the project is actually scaling, like doing a video game. The team is always there, giving daily updates, talking on spaces and AMAs and whatnot. Those are all different aspects of what brings value and proves value to a collection, an NFT collection over time, and what they do. For example, like Bored Apes. Bored Apes had Undocs founders, so no one knew who the founders or the creators of Bored Apes were for a very long period of time. But then it was that was disclosed, and then it was scaled into Yuga Labs, and then the Bored Ape brand, and then others with their other scalings of the project and what they continued to do became a over $1 billion IP brand. So that's kind of the value, like that, of how this how we can democratize the process of building valuable catalogs, right? So when you own a CryptoPunk, you are a co-owner of the CryptoPunk collection. Yes, that CryptoPunk may represent your inner self, but on its own, it's just a JPEG. As we have already discovered, the value is in that collection itself, and the value is created not only by the expertise that went into design and the character generator, but also the owners of the collection. Actually, now the owners of the collection are Yuga Labs, the same owners of BASI. By building an economy powered by co-ownership, we can make future-proof and transparent catalog systems. While yet another restaurant list will hardly add something new to society, there are plenty of situations where decentralized cataloging makes sense. The library. So let's imagine the most basic use of decentralized cataloging. You own a collection of books. You want to share these books with someone. You know, however, there's a good chance that you lend out your books, they will never return them back. That those who you lend your books to will never return them. That's life. So you start a simple process of making a record of each book you're sharing to the decentralized catalog. Only each record is actually in an NFT. The person taking the book decides to use it to put his own books on the catalog and share them with someone else, and that person shares it with their friend too. In a few years, your book sharing club will become an internet phenomenon, with more and more people adding books to the catalog. It's only a matter of time before big publishers join in as well. Some publishers may start adding newly published books to distribute them through the catalog system you created. As we know about the NFT capability, it's clear that the NFT marketplaces and infrastructure we have today will become handy tools and interfaces that will work right out of the box. No need for additional listing websites, centralized bookstores, or payment solutions. It all started with you, who added the first book to as an NFT to the shared collection of books. The same approach is used in Cointelegraph's historical NFT collection. It's a catalog of news from the largest crypto media outlet, and Cointelegraph readers are choosing which news should be added to it. The real future of the NFT standard is ordinary, and that's great. We use many ordinary things each day that were overpriced, and then when they entered the market. As the production and technology evolved, however, the prices dropped and made them available for everyone. The same thing will happen with NFTs. The only thing we need to do now is to stop staring at the tulips and start designing a garden. All right, there we go. So that's a bit about that, an introduction to decentralized NFT catalogs. Let's go into the next piece of news here. This is from TechCrunch. OpenSea CEO Devin Finzer discusses staying on top of a turbulent NFT market at TC sessions in crypto. This is for the weapon here. Okay. Here we go. So the NFT market is worth tens of billions of dollars and saw is worth tens of billions of dollars and saw rapid growth through the crypto bull run. NFT exchange OpenSea, led by CEO co-founder Devin Finzer, emerged as a clear market leader, earning a $13.3 billion valuation in January and controlling an estimated 90% of the overall NFT market. Since then, it's been a bumpy ride for NFTs. Trading volume has fallen over 90% from their January peak, forcing exchanges including OpenSea to conduct steep layoffs. And for OpenSea specifically, competition is mounting as newer entrants such as Magic Eden threaten its dominance, and rumors of an OpenSea IPO have fizzled out. Big tech could stifle long-term growth of the space too, as Apple and Google's high marketplace fees challenge the idea that NFT trading can even reach mobile adoption. There are plenty of challenges on the horizon, but there's also tremendous potential for OpenSea to capture long-term growth in the NFT market if it does indeed occur. There are undeniable pockets of excitement in the space, so the question is whether that excitement will be realized and whether OpenSea is well positioned to capture it. These are some of the topics we'll discuss with Finzer on stage at TechCrunch Sessions Crypto. We'll ask him about what cases for NFTs he sees and the most potential in and where. And we'll hear about how the company plans to sustain its first mover advantage and seize new growth opportunities through a bear market. The event takes place in November 17th in Miami. So it's not even happening. All right, so I will most definitely circle back around on this. So that's a news brief here from TechCrunch. So that's going to be interesting what CEO Devin Finzer says on OpenSeas. Why does it keep throwing me back to that weird page there? Anyways, let's keep going on to there, and I will circle around back to that and check back to what the outcomes of that session was, most definitely. Let's see. Here we go. Next piece of news we have here is from CoinDesk. NFT regulation overlook. We can't stop regulation, Smart Media Technologies exec says. Reeve Collins, Smart Media Technologies co-founder, reacts to a Singapore court ruling that NFTs are properties. We've known for a long time that NFT is a property. It's nice to see a court acknowledgement that, he says, plus his take on NFT regulation in the U.S. are NFTs securities. So that's a video here. It looks like you can check in the CoinDesk sector, and I will have all these recaps on the YouTube side most definitely. So we'll leave in kind of videos like that rather than watching through them. Let's see. Longer sessions, I will play the video most definitely. But we're going to keep rolling through this news. It's Halloween day, so you can probably hear my family piling through back and forth through the background, getting ready for Halloween. Let's see. Yeah, sometimes I'll play videos and we'll talk about it and discuss about it. Also, again, if you're on the chat side, you can throw your comments in the chat. Throw what you think is important or what to cover in news or what's going on, and we'll note about it. Look it up. Let's see what do we have next here. CoinDesk regulation, smart media, CoinDesk TechCrunch. Let's go into this. Let's go into the metaverse news. So we're going to bridge out from NFT news into metaverse news. Forget the metaverse. Meta should make a new Twitter. Let's see what this says. This is opinion side. Daryl Etherington for TechCrunch. So while Mark Zuckerberg burns billions at this altar of the metaverse, a much more practical opportunity directly in his company's lane would provide much more achievable short-term success. Twitter's having identity crisis over new owner Elon Musk, despite showing signs that its social media business isn't what it once was. Meta's Facebook and Instagram networks are still undeniably massive with established revenue fundamentals. It's clear from the recent earnings call that analysts would rather the company and Zuckerberg spend their time and focus on making the most of what it has already achieved in contemporary social media, which does seem smart, even if that ends up being an exercise in managing a long decline into irrelevancy. A drawn out and properly run death is often a more profitable enterprise than a massively costly shift and on focus on an unproven technology like VR after all. Meta is also very experienced and arguably quite good at one thing in particular, cloning the features of its rivals. That's not to say it always gets this right. It's struggling right not to capture the essence of what makes TikTok so appealing. So it's to its users. It has encountered reversals when it has tried to replicate features like its organic out-of-network discovery model in Instagram. Despite reversals, however, Meta has proven determined and resilient when it comes to building, testing, and launching features that give its rivals an edge. Stories and Snap being probably the stickiest and most product-transforming examples of this. Twitter, meanwhile, is facing what is undoubtedly becoming an existential crisis following Elon Musk's successful, if also reluctant, $44 billion leveraged buyout. Over the weekend, immediately following the deal close, reports emerged that Musk had assembled a motley crew of hangers-on and moneyed pals to help advise his overhaul of the company. He's toying with bringing back proto-TikTok video platform Vine, and he's also thinking about making people pay for the blue check that verifies users on the network. People are already considering that the alternatives are if Twitter ceases to serve the function that arguably drives much of its use right now, acting as a kind of town square and one where media personalities in particular feel they can get the attention of and engage in conversation with their peers and with influential personalities who have the ability to amplify their voices. Existing alternatives, including Mastodon, are seeing increase in users' interest in the wake of the Twitter deal closing, but they're unlikely to reach any kind of critical mass long term. Tumblr is a dark horse candidate for occupying the space that Twitter once did, especially if it can achieve current owner Matt Mullenweg's goal of it becoming both the distribution network and the content platform for media. But Meta, with its existing social pedigree and network dynamics, likely has the best chance of being able to replicate what led to Twitter building the user base it currently enjoys, and also growing that while turning it into a money-making enterprise at the same time. Facebook hasn't really tried to replicate Twitter, but Zuckerberg did offer $500 million to take over the network in its infancy in 2008. You could argue that its sub 400 million user base, of which only around half are considered daily active users, is beneath the notice of a company like Meta, which has nearly 2 billion daily active users on Facebook and 1.2 billion monthly active users on Instagram. Twitter, however, is unique in the makeup of its network, and most followed users, which compromise billionaires, politicians, and powerful voices in media, is a desirable audience and likely one that can be monetized, particularly by Meta, the company that is arguably the best in history at monetizing digital consumer products. Building a viable Twitter alternative world, however, meaning increasing Meta's exposure to the fraught landscape of moderation, a landscape Zuckerberg's retreat into his legless virtual world seems specifically designed to avoid. I doubt Zuck has the stomach to spin up a Twitter unencumbered by the mountain of debt now settled firmly on the chest of the current version, but it would be an interesting place for Meta to channel its significant resources that has a lot more historical viability than the metaverse. I'm not so sure about that. Again, this is like an opinion, and I think like Reddit actually recently just put in like Reddit Talk and stuff like that, and things like Twitter Spaces. And so Reddit is also like next to like kind of like what I would think we would like next to Twitter, rather than Zuckerberg, launching something to compete against a Twitter as a social town square app. I mean, kind of like what already Facebook is enacting as, anyways. And to be honest, like those people who are on Twitter, they are on Facebook. The social media conglomerates and wealthy billionaires and shit, they got Facebook profiles. I mean, come on, either that or maybe they're just inactive or whatever. Anyways, let's keep going. Let's see. This is from Financial Times. It's time to plan for the metaverse. No, we don't know what that means either. An FT column offering a behind-the-scenes look at the world of Rutherford Hall, critical communication strategist. Right, okay. This is an opinion from Rutherford Hall. WhatsApp to Steven. Clients are asking me about their metaverse strategy. I'd like to build a bit of expertise here. I don't want to invest too much, but I thought of asking Jules to do some thinking on this. She's under 30, plays video games, and showed me how to use the Find My Phone feature, so she's well placed on all things digital. Also, Priya still in that is Priya still on that project for you. I want some data to wave at clients. Okay, I don't even know what that is. Let's see if this is worthy to keep going with. Monkwell Meta Minute. Yes, you need to be thinking about your metaverse strategy. Forward-looking businesses that are all buying space there. It's cutting edge. It's the future. It's just not very clear what you're going to do there. It is okay. I'll tell you this much. And right now in metaverse, so if you are like an art procurer, an art dealer, and broker, you can build like a 3D metaverse building. You can have a 3D graphic designer, an animator, and sculptor build a building for you in any regards. Like you can even have like like a real estate company or agency that builds their buildings in 3D, have their production suite of studio or whatever devs and designers build you a metaverse building that's maybe an art broker dealer in a 3D building in the metaverse, that then people can visit that on their desktop computers to the metaverse, like Sandbox or Decentraland or Spatial. And then there's the other side through the Yuga Labs, other side Meta that they're building upon in metaverse. And so basically you can go in there and you can be like, I'm an art investor. I'm going to go purchase some art and digital art, and I have an NFT screen in my actual real home that displays NFT artworks rather than having the actual like a physical piece of artwork there. It's all digital based, and it's still immutable because it's backed by a smart contract. And so that piece of artwork you purchased, you went into a metaverse experience. You were walking around like digital. You had a VR headset on, what have you. And you just went and purchased this piece of artwork in a virtual metaverse art broker dealership gallery in three-dimensional space. Anyways, that's what you can do there in one regards. Then there's gaming. It's vastless. Events, concerts. It is way cool. The JP Morgan metaverse site has a tiger walking through the lobby. That's the reality of it. People can literally. I'll say this also. We just noted this recently. Gucci, I noted on the past blockchain tech and finance news, has its vault that just opened. So we'll be checking that out in the Sandbox metaverse on stream here soon. So that's the beauty of it. People can literally pat a tiger while they visit your bank. Well, not literally, but metaphorically. Metaphorically, great. What's less clear is how many times customers will faff around with headsets just to pat an imaginary tiger when it's often a lot easier to use the app. And this is the key point. We all know the metaverse is coming, but few of us know what we'll do when we get there. You'll have seen media coverage of our report showing that 98% of businesses have no plan for the next frontier. There are a lot of bluffers out there. That's why we've set up to Monkwall Metaverse Unit to research that and advise on the best practice. It's time to know your Robux from your sandbox. For sandblocks, right? Yeah, those are currency. So currency of Roblox is Robux or whatever like that, and sandblocks. I don't know. It's like sand is the currency of sandbox. You can visit us in our metaverse office, but it's probably easier to just get in touch with us through the usual channels. WhatsApp to Jules. Excuse me. Oh, damn it. Sandbox and Roblox. Okay, well, if anyone asks, let's just say it was irony. By the way, if the metaverse is so big, why is Meta doing so badly? Let's see. Thanks. So this is a question. We worked hard to get the most advanced digital thinkers. There are a lot of bluffers out there. The simple advice for any CEO is you need to look like a leader with his eye to the future. You don't want to be the guy that still is using an Atari flashback. And no, Meta is not the same as the metaverse. They just want you to think they are. Well, I mean, they're building upon metaverse, so we don't really know what they're doing behind the scenes. They're building a metaverse of some sort. But my advice is, you're not a content creator, so just do enough to look relevant. Create a presence, but don't put in a lot of money till you have a clear use for it. Set up a Skunkworks team in your HQ. Investors love hearing you've got Skunkworks. We'll have to look up what Skunkworks is. I don't really know what that is. Let me know. Let me know in the comments what Skunkworks is if you know. Mention it in every interview and presentation. Most of their ideas will be rubbish, but it's a place to start. Get people who know their stuff. Don't just go for the kid who likes the TikTok and who showed you how to connect the printer. When you build your avatar, try not to look like Mark Zuckerberg. His looks like a Disney character drawn with Botox, or should that be Botlocks? I don't know. We have seen, I don't know, how long is this? Let's see. This kind of keeps going on. They have some key points here. Buy some space. Okay, so buy some metaverse space. Might be investment. There's Satoshi Island. I've been looking at Satoshi Island NFT space. Indeed. So Satoshi Island, that's like digital, both going to physical and island space. It's kind of very interesting. Digital twinning, training, staff, and complex procedures. I'm going to skip this stuff because, let's see. All right, this was a really confusing. But anyways, it's time for the plan for the metaverse. No, we don't know what that means either. So I think it was just some notable things of like what you can prepare for, making an avatar in certain metaverses, getting some land, securing land as whether you invest into, thinking to invest into digital land as holdings to maybe sell to other people in the future for higher returns. All those things are part of like things in the metaverse. Let's keep going on here though. We're going to close out this stream here very soon. Let's see. Should make. Okay, here we go. All right, Wall Street is going to go into some economy, business, and finance news of stock and finance sectors on the global economy and things. Wall Street accused of whitewashing China crackdown in Hong Kong. Activists and U.S. legislators say banking summit being used to legitimize the dismantling of the city's freedoms. So this is from Al Jazeera, writer John Power. Kuala Lumpur, Malaysia. Hong Kong's government invited Wall Street's biggest names to a summit to show the financial hub is open for business after nearly 3 years of isolation due to pandemic curbs. Instead, top bank executives' attendance at the gathering has become a lightning rod for criticism of China's human rights record as participants face pressure to speak out about Hong Kong's disappearing freedoms or stay home. Hong Kong democracy activists and U.S. legislators charge that authorities are using the Global Financial Leaders Investment Summit to whitewash a brutal political crackdown that has transformed the once freewheeling territory beyond recognition. About 200 financial leaders representing top financial institutions, including Goldman Sachs, Morgan Stanley, JP Morgan, UBS, and BlackRock, are expected to attend the summit, which takes place November 1st to the 3rd. During the event, bankers will share a stage with Hong Kong's chief executive John Lee, who is among a number of Hong Kong officials under the United States government sanctions over their role in the crackdown. Okay. On Friday, U.S. legislators Jeff Merkley and Jim McGovern both Democrats warned that bankers risked being complicit in the crackdown in the former British colony, which would promise rights and freedoms that do not exist in mainland China as a condition of its return to Chinese sovereignty in 1997. Since Beijing's introduction of a sweeping national security law in response to violent anti-government protests in 2019, authorities have eliminated practically all political opposition, muzzled civil society, and shuttered independent media. More than 210 people, including legislators, journalists, and union leaders, have been arrested under the law in a colonial-era anti-sedition statute, mostly for crimes related to speech. More than 10,000 people have also been arrested for their involvement or over their involvement in a 2019 protest for crimes ranging from rioting to unlawful assembly. These bankers couldn't even open a checking account for Hong Kong Chief Executive John Lee, who has been blacklisted by the U.S. and is prohibited from traveling to America. Mark Clifford, a former newspaper editor in Hong Kong, who now leads the Committee for Freedom in Hong Kong Foundation, CFHK, told Al Jazeera, international financial centers depend on freedom, free flow of information, and rule of law. Clifford acted. Hong Kong has neither anymore. It doesn't deserve to be taken seriously by the international financial community. Hong Kong's government has rejected criticisms of its human rights records in the summit, with number 2 official Eric Chan on Saturday accusing Western governments of trying to suppress the nominally autonomous territory in China. In a statement to Al Jazeera, the Hong Kong Monetary Authority, the summit's organizer, said, in quote, "We look forward to the thought-provoking constructive discussions at the upcoming summit about how the financial sector can manage a complex set of risks and challenges and harness the power of finance to contribute to the well-being of the global community." JP Morgan Chase, UBS, Mann Group, and Brookfield declined to comment. Goldman Sachs, Morgan Stanley, BlackRock, HSBC, and Standard Chartered, among the participants, did not respond to the request for comment. The controversy around the Hong Kong summit highlights the awkward position facing corporations that seek to cash in on China's growing economic communities while simultaneously taking vocal stances on social justice issues and human rights. The dispute has also underscored how big businesses have often been more reluctant to shun China, the world's largest, second biggest economy, than smaller economies accused of trampling over human rights, such as Russia, North Korea, and Myanmar. Yeah. Despite ignoring calls to skip the Hong Kong summit, JP Morgan Chase and Goldman Sachs were among the long list of major companies to exit Russia over its invasion of Ukraine. Other global brands have shunned Russia, such as Nike and Volkswagen, and have resisted calls to cease operations in China's Xinjiang region, where ethnic minority Uyghurs have faced mass internment and surveillance. The corporate world's desire to stay engaged with China is not surprising, as businesses are rational and often opportunistic actors, said Surya Deva, an expert in business and human rights at Macquarie Law School in Sydney, Australia. They will be participating in the Hong Kong summit because they see more benefits than risk in doing business in Hong Kong and China. Deva, who was previously based in the City University of Hong Kong, told Al Jazeera, businesses have increasingly been forced to care for human rights in a variety of push and pull factors, Deva added. However, these factors are not the same for all places in all situations. For example, it may be easier for companies to leave Myanmar than China. Some human rights experts have suggested that bankers, rather than staying home, could use their voice at the summit to draw attention to the situation in Hong Kong. Last week, CFHK, as part of the advertising blitz aimed at the summit, projected images onto buildings of New York's financial district, urging executives to speak out if they do make the trip. It's such a clear-cut issue as attend or boycott. It's not such a clear-cut issue as attend or boycott. Rather, it's about how executives can use their leverage to raise their voice to show concern about how the rule of law in Hong Kong is eroding. Justin Nolan, a professor of University of New South Wales, UNSW, who studies the intersections of business and human rights, told Al Jazeera. Okay. For example, an executive might attend but make a public statement about concerns, or choose not to attend to associate their absence with concern about human rights and the rule of law in Hong Kong. So far, banks have no indication of any intention to get involved in politics, although 2 executives have pulled out, citing reasons not related to the controversy. Barclays on Monday said that the chief executive C.S. Venkatakrishnan would no longer be traveling to Asia due to changes in his schedule after Citigroup last week announced Chief Executive Jane Fraser has canceled due to testing positive for COVID-19. While Wall Street may prefer to stay silent and the controversy, companies are only going to find it harder to draw a light red line between business and human rights, Nolan said. Look at the pressure on companies sponsoring the upcoming World Cup to contribute to a fund to compensate migrant workers for the losses they have suffered in the lead up. Look at the pressure on Adidas to respond and take action on their relationship with Kanye West, she said. Business has changed, and public-facing companies and brands no longer have the luxury of turning a blind eye to environmental and human rights abuses. I guess that was interesting. They threw the Kanye West. That's been a recent thing. Kanye West and Adidas. So they threw that in there. Because obviously there's some financial damages going on there. Wall Street accused of whitewashing China crackdown in Hong Kong, right? That's from Al Jazeera News. Let's keep going on. We have another piece of news here to keep going and close this out. So this is from Yahoo Finance. Writer Brian Sawsey, anchor editor at large. 3 earnings season stories that investors should recognize in the morning brief. This article is, Let's see. I realize that market watchers have become even more obsessed with imminent Fed decisions of what officials in various interviews, such as on Yahoo Finance, but there is more going on in business and finance than the central bank. Let's make sure. Okay, I'll pause this video up. And if we're learning anything of this coming season, it's that surprisingly a good time to be a stock picker at the market. Clearly, as the market clearly defines winning companies versus losing companies. To that end, there are a few stories we have recently caught my attention. Look at GameStop Go. Remember when GME was over $347 share at the height of the meme stock craze in late January 2021? The stock split 4-1 in July 2022. Well, yeah, it's a $28 stock today as the company has continued to operationally struggle, and Ryan Cohen enjoys sending bizarre tweets out of his Florida compound. Readers of the Morning Brief know where the writer stands on GME, but that is neither here nor there. GME stock has quietly risen 11% in the past month. S3 Partners CEO Bob Sloan, the Wall Street veteran who just in the new Netflix doc on the meme stock craze, made a good point on GME on Yahoo Finance Live. If you look at GME, I think there's still $1 billion too short in the stock. If it goes past $30, you could see something parabolic. Bob's comments went viral on Reddit and saw heavy interest in the Yahoo Finance Twitter feed, perhaps teasing another push higher in the stock for whatever the reason. After all, it's almost the holiday season, video game sales pick up, and the company still has its hardcore fan base. McDonald's is back on a big way. The Golden Arches put up a third quarter that checked out a lot of boxes for Wall Street bulls. Tasty U.S. same-store sales increase a 6% or higher traffic. U.S. same-store sales above consensus increase of 4% and 3 solid earnings called by management. Yahoo Finance's Brooke De Palma reports that consumers aren't even balking at the higher prices for Big Macs and fries. Clearly, the company has tapped into something with the return of Halloween Happy Meal pails, adult Happy Meal toys, and the beloved McRib. That momentum could carry McDonald's into year-end, argues longtime restaurant analyst David Palmer at Evercore ISI. While declining consumer sentiment in the U.S. and Europe is concerned, McDonald's has shown its historical resiliency in recessions. We believe McDonald's is firing on full cylinders, including one, impactful marketing and promotions, adult Happy Meals and McRib farewell tour, a strong digital loyalty engagement, and renovated store assets and premium food options. Economic slowdown hasn't hurt Bud Light sales. I spent some time talking with AB InBev CEO Michael Decoris, following a third quarter report that I think surprised a lot of folks positively. Total sales were up 12.1% and total volumes gained 3.7%. The company saw strength in higher priced Corona and its Beyond Beer segment, which consists of higher priced non-beers such as hard seltzers. Decoris tells me he isn't seeing inflation crushed consumers trade Down in their beers, actually the opposite. The company could also see a big sales boost from the World Cup, which kicks off in late November. It may be worth it this week to crack open a cold one and run down your own analysis on AB InBev. Let's see what to watch today in the economy. We have the M&I Chicago PMI, Dallas Fed manufacturing activity, and the earnings, Aflac Williams Companies on semiconductor, Lowe's Corporation, Marriott Vacations Worldwide, Vornado Realty Trust, and PriceSmart. All right, so let's set that there for 3 earnings season stories that investors should recognize. That's from the Yahoo Morning Brief. All right, let's go into the BBC. Your next job interview could take place in virtual reality. So I have 2 articles here left, right? Yeah. And we're going to close out the stream for the day. It's from Elizabeth Hodson. Going for a job interview is the stuff of nightmares for many people, while for others it is a chance to shine. Either way, you are typically still interviewed by other human beings, either after walking into a scary office or one with more bosses sitting behind a desk, or via an equally nerve-wracking Zoom call. Yet thanks to advances in artificial intelligence, AI, and virtual reality VR technology, you may soon be interviewed for that job you really want by a computer. Early this year, students at Sandwell College in West Bromwich put on a VR headsets to do some mock interviews. Their avatars, cartoon-like representatives of themselves, were put through their paces by another talking avatar representing the AI software system. I never had an interview before in my life, says engineering student Ayan Ahmed, but because there is no human judging me, it was all online. And it was all online, I could actually express myself. And then at the end of the process, the VR interview, told me that I did what I did wrong and what I did right. It really helped me to know what to do in my next interview. The VR system the students were using is made by London-based company Body Swaps. The questions and requests that the interviewees got asked range from straightforward, tell me about your greatest achievements, to more challenging, do you prefer to be loved or feared? The user then gets feedback not just on what they said, but how they say it, whether they are maintaining eye contact with the interviewer, avatar, and even their posture. Body Swap's chief executive Christophe Mallet says the idea is that people can keep practicing in the simulated job interview until they feel ready for a real life one. He believes that the technology has the chance to level the playing field for candidates from less well-off backgrounds who might not otherwise have the opportunity to practice for job interviews in a professional setting. Things like communication, empathy, and leadership are the secrets to success in interviews, but how can you practice those? If you are rich, you can get a coach. Otherwise, you have e-learning, such as watching videos in the topic, but that doesn't work for you, as you're lacking immersion. Using VR and AI, we now have a way to immerse you safely in a simulation where you can practice interview conversations. So Body Swaps launched an interview simulations last year, and it says it's mainly targeting schools, colleges, and universities so their students can practice before they enter the jobs market. Its business model is subscription-based, with the amount of institutions an institution has to pay each year, being dependent on how many people use the system. While Body Swaps is currently focused on mock job interrogations, the AI technology of Swedish firm Tengai is already allowing firms out in the real world to get a computer to do their initial job interviews. The AI software is represented as a talking cartoon head that appears in the screen of a candidate's computer or smartphone. It asks a set list of questions, and then the recorded answers are used to help recruiters draw shortlists for jobs. Tenkai's chief executive, Ellen Oberg Martinsson, says that a central aim of the software is to avoid wrong assumptions, such as judging someone on their appearance. We wanted to create a situation where you could actually look at objective data instead by putting some sort of filter between the candidate and the recruiter, she says. And that filter is supposed to mitigate bias in the process so that they know that they are not being judged by things other than those relating to the job description. But while it might be tempting to see AI and VR technology as the magical solution for selecting the right candidate for a job, employment lawyer Susan Thompson says we need to be cautious. AI doesn't eliminate risk, and it's not without risk itself, says the partner at London law firm Simkins. Also, I think that's the most important thing employers need to be mindful of. We have to remember AI is actually still fundamentally created by a human. So first and foremost, I'd be saying to any employer who's thinking of using it, be it at the interview stage or even at the exit stage, do you understand it? And to what extent have you spoken to the developer about what data points it uses? And has it been stress tested to eliminate biases? Does it eliminate gender bias, and how does it do that? Ms. Thompson adds, I would be hesitant in advocating that AI is used exclusively in the interview process. I think there should be some sort of human intervention somewhere. Yeah, I agree with that most definitely. But yeah, this is an interesting step, and this is in the tech news sector of this blockchain tech and finance news segment and live stream episode. So this is from BBC. Your next job interview could take place in virtual reality. So I have two pieces of news here left. We're going to close out the stream for the day. This is from Global News, General News, CNBC writer Holly Elliott, Amanda Macias, and Rocio Fabro. Reporters and editors are writers. Wave of missile strikes hit Ukrainian cities, with Kyiv left struggling for power and water. Wheat prices rise after grain deal stumbles. This is from Live Updates. A series of missile strikes hit major Ukrainian cities on Monday morning, with this morning, with capital Kyiv and cities in the northeast and south being targeted, according to regional officials. Kyiv's mayor Vitaly Klitschko said on Telegram that part of the capital has been cut off by the strikes, which he said had hit critical infrastructure facilities. There is no water supply in some areas, he said. Meanwhile, global wheat prices have started to rise following Russia's withdrawal from the Black Sea grain export deal last weekend. Russia announced Saturday that it was suspending involvement in the Black Sea grain initiative that was brokered in July, and which allowed vital agricultural products to be exported from several Ukrainian ports. The UN and Turkey, which helped broker the deal, which said they were working with Russia and Ukraine to help move ships stuck within their maritime corridor being used in the initiative. So let's say Ukraine says it shot down nearly all of Russia's early morning missile strikes. Ukraine's Air Force said it shot down about 44 of the approximately 50 recorded Russian missiles that rained down across Ukrainian cities this morning. Last week, Ukrainian military spokesman Yuri Ihnat said the country's Air Force has shot down more than 300 Iranian Shahed 136 kamikaze drones since Russia introduced the new weapons on the battlefield. Ihnat has previously hailed Western air defense systems encountering Russian missile strikes. In recent weeks, Moscow has carried out several devastating missile and drone strikes against what Kyiv said were civilian targets and critical infrastructures such as energy facilities. Iran and Russia's representatives at the United Nations have sharply denied reports that Tehran supplied Moscow with a fleet of drones to use in Ukraine. The Kremlin has repeatedly denied that it uses Iranian-made drones to target residential and other high civilian areas. From Amanda Marcius. U.S. Embassy in Kyiv takes shelter after a barrage of Russian missile strikes. The U.S. Embassy in Kyiv said it was taking shelter after a barrage of Russian missile strikes pounded major Ukrainian cities. Like millions of Ukrainians, our U.S. Embassy in Kyiv team is once again taking shelter as Russia continues its callous and barbaric missile strikes on the people of Ukraine in an effort to leave the country cold and dark as we approach winter. U.S. Ambassador Bridget Brink wrote in a tweet here. Ukraine Prime Minister denies Denis Shmyhal said Russia. I thought I said denies. Sorry, Minister Denis Shmyhal said Russia's shelling of various regions in Ukraine appeared to target civilian energy infrastructure. Missiles and drones hit 10 regions where 18 facilities were damaged, most of which were energy related. He wrote on Telegram. He added that 80% of Kyiv was without power. All right. So yeah, this is kind of continuing on here. And it kind of goes through actually a bunch of other news articles. So I'm going to leave it here. And the main point is here, a wave of missile strikes hit Ukrainian cities with Kyiv left struggling for power and water. Wheat prices rise after grain deal stumbles, especially going on to the cold winter here. This last piece of news is from Financial Times. Oh, wait, it's not. It's going to cut me off there. All right, we're going to leave it at this. With this last article here. and yeah, something needs to change and get better like that. That's all I have for the news today. If you're on the YouTube side, please do subscribe, turn on bell notifications. Here to Blockchain Tech and Finance News. Wherever in the world you are, have a great and safe day. No matter where you are, stay safe, most definitely. And yeah, I pray you have a great and awesome, safe day. I'll see you back tomorrow here on Blockchain Tech and Finance News. Also, I will have all these articles on the YouTube side, so you can read through at your own due diligence, research more, and it'll be on the YouTube on Blockchain Tech and Finance playlist on my YouTube channel, Kentoshi. All right, again, stay safe. Have a great and safe day. Cheers, ciao. Peace be with you.